In this video, I'll be sharing my 3 favorite dividend-paying stocks traded on the 2 exchanges in the United States, both the NYSE and the NASDAQ. To narrow down to just 3, I won't simply be looking at their dividend yield today. I'll be basing this off of their payout ratio, their ability to sustainably pay a dividend over the long run through having a solid business, good liquidity, and they should have managed to increase their dividends over time, showing they are becoming more profitable over time and sharing that with shareholders. If you want to see more investing content just like this, please make sure to subscribe to my channel down below. Before getting into the list, let's cover off some basics. Let's think about a business for a second. Let's say it has a revenue of $1,000 a year, costs of $900, and a profit of $100. The business has 2 options when it comes to the $100 profit. The first option is to retain the whole or a portion of the $100 and use this to reinvest into the business in a variety of ways. It can acquire a competitor's business, it can reinvest in property, plant and equipment, or inventory, or it could be used for upgrading the premises or paying bonuses to staff. The second option available is to return these funds to the investors, also known as shareholders or the ones that own the stock. This distribution is called a dividend. They can also do this through what's called a share buyback, which can have its tax advantages. The percentage of the profit that is returned to shareholders each year is called the payout ratio, representing how much of the profits is returned to investors. When you look at a dividend-paying stock, you generally want a high payout ratio, as long as the business retains enough cash to keep the wheels turning, so to speak. So highly profitable business with a low capital expenditure tends to be highly prized in the dividend world. A good example of which is the Coca-Cola company. The product is of course very profitable. Its revenues grow year after year. It has relatively modest capital expenditure, and it has paid dividends for decades, increasing almost every year. This is what I'm looking for in this video. The first company I would like to highlight is Verizon Communications, traded on the New York Stock Exchange under the ticker VZ. Verizon is a telecommunications powerhouse mainly serving the United States, generating a tidy $136 billion each and every single year in revenue, putting it in the top 20 companies in the US by revenue. The business is broadly split into 2 segments, both their consumer and their business arms. On the consumer side, they are America's second largest mobile carrier after AT&T, with 143 million subscribers. A further 8 million people use Verizon for their broadband internet services. From a revenue standpoint, the consumer business contributes just over $100 billion in revenue. The remainder comes from their business arm, providing many of the same services extended to their consumer segment. They have 29 million mobile subscribers and 1 million on the broadband side. Looking at the business risks, which could impact future dividend payments, these include risk of cyber attack, huge competition in the telecom sector, natural disasters of course, which could affect the telco infrastructure, and regulatory changes, just like most businesses. More importantly is the level of debt Verizon has on the books. In the future, free cash flow could be directed towards paying down debt instead of being paid out as a shareholder distribution. With over $140 billion in long-term debt, but just $21 billion in net income each year, this is a multiple of about 7 times. In other words, it would take 7 years of profit to pay down the company's long-term debt. Fortunately, much of this is long dated, and over the next 5 years or so, the annual debt maturity sits between 6 and 16 billion. The largest 16 billion tranche of this hits in 2024, which poses a risk for that dividend payout. The annual dividend yield currently sits at 6.9%, with payments quarterly, and as you can see here, the company has a long history of increasing their dividend payment each year. The payout ratio has varied, but is typically around the 50% mark, meaning for every $1 they earn, 50 cents is shared with investors. One of the great things with telecom companies, not only in America but around the world, is how stable they are from a financial standpoint. As you can see here, their revenue has barely moved since 2016, while their net income has been steadily increasing since 2019. So overall, with a decent dividend yield, history of increasing the nominal payout, and obviously a very stable outlook, Verizon was a must for me in this list of my top 3 favorite dividend stocks in the United States. Second up, we have Warren Buffett's favorite, the Coca-Cola Company. Trading on the New York Stock Exchange under the ticker KO, Coca-Cola has been a long-term favorite for investors chasing yield on the US exchanges. It goes without saying that Coca-Cola is a global drinks powerhouse with a history dating back to 1886. There's not many places on earth you can go without seeing a Coca-Cola can at the convenience store. They are of course most well known for Coca-Cola, but but over time have invented or acquired literally hundreds of other brands. When I went looking, they had a whole Wikipedia article dedicated to them all. To name just a few, in the drink range they have Coke, Fanta, Sprite, and Thumbs Up, which I'll be drinking lots of in India this month. In the water and sports drink range, there's Dasani, Vitamin Water, and Powerade. And finally, juices such as Innocent and Minute Maid. The segments Coca-Cola operate are broadly 4 geographic regions for the FMCG front: a bottling and distribution arm that handles the manufacturing of drink products, and Global Ventures, which handles all other global business, including the distribution for Monster Energy Drink and Costa Coffee. Looking at this revenue split, North America makes the most money for the Coca-Cola company. When we look at the operating margins, however, North America is less than half as profitable as the other 3 geographic regions. Looking at the potential risks to our dividend payment, they make mention of a few. Aside from geopolitical risks, Coca-Cola mentions poor drinks innovation, loss of food service contracts such as with McDonald's and Subway, increased competition, the inability to grow in emerging markets, another pandemic, growing health-related concerns which could reduce the demand for some products, among many others listed in their 10K report. Looking at the financials of Coca-Cola, it's not hard to see why it's an investor's favorite. On its $43 billion in annual revenue, Coca-Cola retains about $9.5 billion as its net income, or about 22%. This, of course, is very healthy. If we look at the trend since 2010, revenue has moved around a fair bit. However, the company always manages to keep its profitability at about the same level. Moving through their financial statements, we can see they have a reasonable cash balance of $9.5 billion and long-term debt of just $36 billion. As a proportion of annual net income, Verizon's debt burden was about twice as heavy. The current assets also more than cover the current liabilities, making this a very stable company. The annual dividend yield currently sits at 3.1%, and the nominal dividend payment has grown for a whopping 61 years straight. If we look at the payout ratio, this stands at 72%, which is very high as compared to many stocks on the American exchanges. For all these reasons, Coca-Cola is a highly stable business that over a span of decades has shared the lion's share of all profits with their shareholders. With a pivot in their product lineup towards healthier alternatives and a strong cash position, Coca-Cola is in an excellent position to continue rewarding shareholders and pivot their business as needed over the coming years. And finally, we have my third favorite dividend stock traded on American exchanges, and that's AbbVie. AbbVie is a pharmaceutical company that was spun off from Abbott Laboratories in 2013. What makes this stock a dividend powerhouse, aside from its dividend of over 4%, is the fact that it has increased its nominal quarterly dividend payment by over 270% over the past decade. Add to this the fact that it has increased its dividend, including the time it was under Abbott's ownership, for the past 52 years. So needless to say, this stock has a right to be on this list. Over the past 10 years, the company has grown its revenue from $18 billion to 58. It has more than doubled its employee count, and it has over 30 brands of pharmaceutical products. So let's look into those. AbbVie has 5 key areas of healthcare it operates in, namely immunology, oncology, aesthetics, neuroscience, and eye care. Botox is an example of one of their products, so I guess you could say this company is endorsed by the Kardashians. As is usual with drug companies, the regulatory risk is among the most important. Firstly, their R&D might go to waste if they're not able to discover new drug products. Secondly, they could lose their patents faster than expected, or competitors could create a better or cheaper alternative. There is a long list on their 10K reporting of all the peril of the pharmaceutical industry. Adding to these factors is an over-reliance on a single drug called Humira, which provides $21 billion in revenue for the company each and every single year, or just over a third of its total revenue. So protecting this income is critical for the firm. What we can be positive about for this company is its large profits. As you can see here, their gross profit margin is a whopping 70% and has increased from 66% just a couple years ago. Its revenue stands at $58 billion a year. Its operating earnings at $18 billion, and its net earnings stand at $11.8 billion. So the company is hugely profitable, and this has only increased in recent years, as you can see here for their revenue, and here for their profits. AbbVie has strong cash holdings of $9.2 billion, and long-term debts of $59 billion, putting it near Verizon in terms of the amount of debt they've taken on. Their current liabilities slightly outweigh their current assets, so they will need to watch this so as to not impact their cash balance over the next year. As was mentioned earlier, AbbVie currently has a dividend yield of 4.3%, and their nominal payout has been increasing. Their payout ratio is currently an unsustainable 150+%, which as the business grows, this should subside to a more sustainable level. AbbVie is definitely a more left field pick in this list for its exceptional dividend and history of increasing its payouts. Investors should be careful just in case management decide to prioritize paying down debt, or if there are major updates on the market for their Humira drug. I hope you enjoyed this video. If you did, please make sure to subscribe to my channel down below to see all my future content in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.